Good afternoon, everyone. Can anyone respond? My voice is clear. It is audible.
Yes, sir.
Yes, sir.
Shabina or Uma, anyone, please. My voice is clear now.
Yes, sir.
Okay, ma. Good afternoon, everyone. Earlier classes we discussed up to capital markets, right? Today we in capital markets we discuss one important topic, that is big book building process. So see exactly what is happening in particular stock market for offering of issue of new shares through IPO. So this is the website of NSC. In this particular NSC, just see the third thing. One is this is IPO. IPO means initial public offer. Using this IPO, investors they can invest in particular company. So till now, today actually three uh, major companies are offering IPOs. That is Fenbox Retail Limited, Delapix Limited, Docomoid Health Technologies Limited. These three are issuing shares through equity shareholders, through get the money from investors. So just see here in what is mentioning in this particular one. So just see the book number 68. Everyone has books, right? See the book. This is the company name, Fenbox Retail Limited. So here what is happening is category. Which category it is? Actually, they are offering total 2 crores 65 lakhs 18,000 shares to the general public through issuing of IPO. They are collecting the money from the general public. So then what way they are collecting means through FIS, foreign institutional investors. How much they are collecting? They are not issuing the foreigners and foreign institutional investors, and domestic in financial institutions also not available, and so mutual fund companies also not getting any shares. They are not offering to the general mutual funds. But qualified institutional buyers, they are offering 4,000 shares. And non-institutional investors, like these are all the institutions like pension fund managers or mutual fund investors or FIIs are different. And different financial institutions, they can get the money from, they get invest in money in particular company, but they are offering only qualified institutional buyers. How many shares they are offering? Initially they are offering 4,000 shares. So non-institutional investors, they are offering 39 lakhs 48,000. Okay, in non-institutional investors, then sub-categorized into corporates, individuals, and others. Corporate means any company they can purchase the shares through corporate portal. Portal. Then individuals means like us, we can buy the shares directly through our demat account or bank account. So these are all the remaining shares to the retail individual investors. Likewise, they are issuing 2 crores 65 lakhs 18,000 shares. They're just to see the demand graph, how much they are getting. Actually, total bid received is 2 crores 65 lakhs 18,000. Total bid received in cutoff price. The So till now, only 1 crore 11 lakhs 54,000 shares only they are issued already. So issue information. So then what way they are issuing shares means book building process. Just see the definition of book building. The company proposing to issue shares appoints a merchant banker as a big book runner and a lead manager. Here, what is the book runner and lead manager here? Here. Beeline Capital Advisors Private Limited. They are appointed as this company private limited as appointed as a book runner and a lead manager. So for issuing of IPO, this book running and lead manager they will take care of everything about the issue of price and allotment of shares and everything. So what is the share value means here? Face value is 10 rupees. Okay. Price range. This is the price range in between. Exact face value is initial what they are issuing price. Okay. So between 66 rupees to 70 rupees in between they are offering the shares for each share value. So after the closing of issue they can fix the price. So just see the points. The issuing company appoints a SEBI, as per SEBI regulations. First, they appoint the lead manager, book runner and lead manager. That is Capital Advisory Private Limited. Then after BRM submit the draft to this SBI. This lead manager submit the draft prospectus to the SEBI. Third point is the issuing company and BRLM decide the price by and between with the investors quote price and which they are ready to buy the shares. So here, 1 minute. So fourth point is the issuing company advertise the issue shares, monitoring the operations, closing of the bid dates for the bid. The bids are open usually for the period of 5 days. So let's see here. These are all regarding to the bid price and everything. This is the demand of the form. So likewise, they are issue the shares. Then after fifth point is the syndicate members entered in the order to receive into a electronic book. So likewise, even corporates and individuals, foreign institutional investors and other investors, they can log into this particular portal and they purchase the shares through online. Bids can be received by the bidders from the book closes before closing of bid. So how many shares they are purchasing, they get the information from the particular investors. On the close of bidding period, the book runner evaluate the bids on the basis of the demand shares various price levels. So initially they are offering 66 rupees to 70 rupees. So in between the investors they will purchase somebody purchase from 68 rupees, somebody purchase from the 69 rupees, somebody purchase the 70 rupees for each share. So it is discretionary about it is depending upon the particular investors purchasing point of view. Then after closing of the bid, this prospectus giving details to the number of shares allotted to filled with the register of companies. So after closing of the bid, in detailed information giving to the register of companies. The allotment is made as per this SEBI guidelines. The different categories investors are as follows. So here earlier we discussed this 35% is total investments. So total retail investors they are getting through retail investors they are getting 1 crore 11 lakhs 54,000. It means near to 35% of total. It is near to 50%. Actually, they are giving 50% up to the RIAs. Next, non-institutional investors, exactly 15% issue is reserved for NIAs. Then qualified institutional buyers, they can collect the money from qualified institutional investors 50%. Up to 50%, up to 50% they will issue the shares to the qualified institutional buyers, and 35% to the retail investors, institutional investors, and 15% to the NIAs. So behind that, they don't have to issue more shares, more shares. So likewise, this process is going on. So this is the big book building process. Coming to the next chapter, that is money market. Okay. Money market. Money market is nothing but market is borrowing and lending of short-term funds take place. It is less than 1 year or maximum of 1 year. In money market, it consists of negotiable instruments such as treasury bills, commercial papers, and certificate of deposits. So money market is nothing but it is issued to the general public within 1 year, within to repayment condition of within 1 year. So this is very short term period of issue. Earlier capital is it is a long term period of long term for particular purpose of long term period, but money market is deals with only for up to 1 year. So it is consist of negotiable instruments such as treasury bills, commercial paper, and certificate of deposits. So just see the page number 80. Money markets are those markets where borrowing, lending of short-term funds take place. By short-term, we refers to period of less than maximum of 1 year. It is a market which deals with various short period instruments that is enable leading and borrowing, lending and borrowing activities in the market. The post reforms after the reforms, post reform after the reforms, the growth in the money market is increasing day by day. In this particular unit, we discuss about the functions of the money market and structure of the money market and characteristics of money market. These three things we discussed in particular sixth unit, that is money market. Okay, the coming to the definition regarding to the definition of money market. Money market is consist of negotiable instruments such as treasury bills, commercial paper, and certificate of deposits. So individually we discuss about in coming slides. So various financial institutions, dealers, and corporates who seeks to borrow the lend for short period participation in the market. Money market is a considered as the best avenue to invest in a liquid assets and source of borrow money from short period at competitive rates. So money market is nothing but for a smooth running of the business or smooth conducting of day to day organization activities, they need some money. For example, if we are a salaried employee, so for example, I am receiving 50,000 rupees of salary for the month. That means 30 days, for the working of 30 days, I get the 50,000 rupees. So in this particular 50,000 rupees, I cannot go invest in a total amount in a single product or single asset. So for day to day purpose, I need to maintain some corpus money, or I need to maintain some money in my pocket for running day to day expenses and day to day for smooth running of day to day activities. Likewise, even companies also, they don't they also need some money for running of the day to day organization, day to day activities of the organization. So likewise, earlier we discussing about one IPO company, that company is issuing shares, means they are collecting around 2000 crores, like around, I don't know exactly, but nearly that amount they are collecting from the issuing of IPO. So the entire that amount, full amount cannot purchase the fixed assets or cannot purchase the land and buildings, cannot invest in a particular plant and machinery, but they need to maintain some cash reserves also for a smooth running of day to day expenses, day to day activities. For example, for any organization, they need to maintain maintain the organization smoothly. They need some fixed assets, as well as they need some current assets. They need some cash reserves or current assets also. So huge amount is blacked in the fixed assets, but compared to the fixed assets, in lesser amount is blacked in particular current assets. So in this current assets, we are discussing, but in this particular earlier we discussed about the fixed, that is capital markets, but now we discussing about the short term investments or short term capital or money markets. Money market is nothing but it is a short term investment or short term borrowing to the general public, uh, that is below the 1 year, okay, less than the 1 year investment purpose, and they are giving loan to the less than 1 year purpose only. So these are the instruments for they are for investment or getting the money from general public or company, that is treasury bills, commercial paper, and certificate of deposits. So what is the main functions of the money market? Money market instruments are the liquid and can be converted into the cash easily. So if we are investing in the money market is nothing but it is a liquid, and it can be easily convertible into cash, easily converted into the cash. For example, I purchased one bike last month. So that if immediately I need some money, then it is possible to get the money, sell the bike and get the money immediately. So that is not possible immediately. So it will take some time for sale of fixed assets or long-term asset. For compared to the long-term asset or a fixed asset, this short-term instruments are easily convertible into the cash. For example, I cannot sell the bike immediately, but I can sell the petrol immediately. For example, I have a 2 liters of petrol, so I need immediately some immediately money from immediately money. Then I what I do, just I simply go and I stand in petrol bunk. Then I sell petrol and immediately I get the money. But likewise, I cannot get the sell of fixed asset immediately. I cannot get the money from fixed assets. But compared to the fixed assets, this money market instruments, I can easily easily get the money or easily convertible into the cash easily. Then maintaining monetary equivalence by maintaining the balance of between the short-term period and demand and supply of the money. So here in main function maintain the long term maintain the short period and short period of demand and supply of the money. So in equilibrium, and how much money I need for routine works or day-to-day activities, that amount only I kept. Behind that amount also kept into the empty hands also, it is not useful and it is not a profit motive. It is lost to the organization also. Second point is by making adequate funds available. By making adequate funds available to the various sectors of the economy, such as agriculture, industry, service, money market, promotes the economic growth. So, for agriculture purpose and industries and service sectors also, through this money market instruments, they can maintain the adequate sufficient funds to smooth running of the organizations or smooth running of the industries. Third point is money market provides the financial supports in various forms, such as facility of foreign bill discounting and short period credit against to the trade bills. So trade bills కోసం కానీ ట్రేడ్ బిల్స్ ఆర్ ఫారెన్ బిల్స్ ఏమైనా డిస్కౌంట్ చేసుకోవడానికి డిస్కౌంట్ త్రూ foreign bills are short-term credit, short-term through issuing of the bill, they can get the discounted value of money. Then after fourth point, it provides a mechanism for the effective implementation of the monetary policy. So it provides the effective implementation of the policy. Fifth point is money market makes available investment options for short-term period and thereby the encourage the savings, channelizing savings into investment. So, for example, anybody is getting more money or getting more in hand. So what they can do, they can purchase any shares or stocks or any fixed assets or any land and buildings. So likewise, that particular investors or particular people, they can save money and they can invest the money. So that is through that saving and investments, the particular industry or particular country, they can take through they develop the they can develop. Then after money market provides the non-inflationary sources of finance to the government. By issuing treasury bills in a money market, the government raise the funds required to meet the budget deficits. Even government also, they are issuing for running of the government smoothly day to day in simple way. For example, they pay to the they are paying to the salaries to the government employees, and government is paying some subsidy basis. They are giving some money to the people. Likewise, money also, government also, they need short-term money. So how that government, how can they can raise the money through issue the this particular treasury bill. Through treasury bills only they are that money they are receiving to meet the budget deficits. These are the functions of the money market. This is the main difference between the money market and capital market. These are all the parameters, and this is the money market and this is the capital market. What is the main function of the particular money market is it is short-term credit facilities. It provides the money market provides the only short-term credit. Capital market provides the long-term credit facility. Market type. It is a informal way or formal way. It is a regulated and formal way. So capital market is purely regulated by the SEBI, and it is a formal, it is official. So money market, if anybody needs some money, to invest or to daily to our for example, I need some money from money for some urgent purpose. So what can I do? I simply go and ask my friends or any my colleagues or any other person who I know. Then I simply go and I take the money from the particular persons or through general public, but general whom I know. So, but coming to the company, it is not possible to the getting the money immediately. So what they can do, they can issue the treasury bills or commercial paper, certificate of deposits. Likewise, they can issue this that particular money market instruments. They collect the money. Okay, then categories here there is no particular categories, but coming to the capital markets, we capital markets is divided into primary market and secondary market. Transaction type over the counter. Over the counter means directly we approach and directly we get the money. But coming to this capital market, it is exchange or it is giving some assurance or some giving some in some other. For example, I'm issuing of shares. Likewise, they are getting the money through capital markets. Here the instruments are commercial deposits, treasury bills, commercial paper, extra, but etc. And also coming to the capital markets, that instruments are only equity shares, corporate bonds, or government securities, or debentures. Likewise, they can get the money and the liquidity, more liquidity than the capital markets. If in money market compared to the capital markets, money market have more liquid and maturity tenure. It is between 1 day to 365 days or less than 1 year. But there is no particular time period for capital markets. The risk is in money market is very less. In capital markets, risk is very high. And also participations in this particular money markets, participants are banks, similar financial institutions. But here, capital market participants are underwriters, insurance companies, mutual funds, retail investors, stock brokers, and stock exchanges. These are all the participations in the capital markets. Here returns every year or every month, they can fixed consistent returns they are in particular money market. In coming to the capital markets, it is market linked. It is market depending upon the market, they can get the money. So these are all the main differences between the money market and capital market. So next, structure of the Indian money market. This is the Indian money market structure. So earlier this chart also earlier we discussed, but just see recollect the Indian this market Indian market money market chart. So Indian money market consists of three things. One is unorganized sector, organized sector, cooperative sector. So in particular unorganized sector, here what in particular unorganized sector, what will be coming means money lenders. Means generally they are giving money through 2 rupees interest or 3 rupees interest, 5 rupees interest for short term, and they collect the interest and principal amount. Likewise, this money lenders giving the money to the general public and indigenous bankers. There is no particular recognition, but they are also give some money and they collect the huge amount of interest and nidhis chit funds. Everybody salaried employer or somebody there every month they they are pay the money. They are grouping 15% or 20%, 10%. They group individually. They every month one person lift the chitti and they take the money for then next month they for coming to the next month other person they take the money. Likewise, chit funds are uh, happening. Then after organized sector consists of RBI, public sector banks, private sector banks, development banks, and development banks and financial institutions, and this DFHI. In public sector, banks consist of SBI Group and also other nationalized Punjab National Banks, Indian Overseas Bank, Andhra Bank, like these are all the banks coming under the public sector banks. Private sector banks consist of scheduled banks and non-scheduled banks. Private banks, for example, Indian banks, that is ICICI, and other banks are foreign banks and Indian banks. Development banks are banks and financial institutions, UTI, Unit Trust of India, LIC, IFC, IDBI. This particularly each organization they are giving some specific industries only. They are incorporated for the purpose of specific purpose only. So these are all. This is the structure of Indian money market system or Indian money market key players. Structure of the Indian money market. Entire market is dominated by the small number of large players. Okay, so this Indian money market is dominated by the small number of large players. Okay, then the money market regulated by the RBI and SEBI, Securities Exchange Board of India. This is also come on. This is also one type of this is also type of Indian money market, that is organized money market and unorganized market. Likewise, sub markets can be divided into call money market, bill market, 365 days bill market, commercial deposits and commercial paper, certificate of deposits and certificate of paper, commercial papers. Then after commercial bills and treasury bills. So these are all the characteristics of a developed money market. So what is the main characteristics of the this particular for developing of the money market? So that is existence of strong central bank which effectively controls the money market. So then how money market is developed? So like RBI is authorizing central bank for all banks and money controlling purpose. Likewise, if incorporate any central bank, then we control the money market. Then after high organized commercial banking system, which deals in a variety of short-term instruments. So high organized commercial banking system, which it is deals with the short one, different type, but now we have only 4 or 5 types of money market instruments. But if develop the money market, we can issue the more type of money market instruments to the general public and also government. So likewise, we can develop the money market. And the third one is existence of well-developed sub-markets which broadness and deepens money market operations. Fourth one is prevents of reasonable and healthy competition among the sub-markets. So reasonable, healthy and healthy competition among the we have less money market players only. So they are reasonably and healthy competition. They through that way also we can develop the money market. A developed money market has adequate supply of necessary credit instruments such as treasury bills, promissory note, and bills bills of exchange. The flow of funds into the money market should also flexible enough. The flow of funds can be increased or decreased depending upon the demand for the funds. So depending on the demand for the depending upon the funds, uh, the that way only we can influence the we can develop the money market. Pre- prevents of uniformity in interest rates different parts of the country. It characteristic futures develop the money market. So somebody in money market, somebody they are taking 2%, they are taking 10%, they are taking 20%, 30%. Likewise, there is no unity, or there is no uniform rate of rate. So based on that thing only, this money market is not developed. So one one rate of interest with particular controlling bank they impose. Likewise, this money market also increased because of the fixed rate of interest. The money market will functioning of smoothly can achieve the basic purpose of its existence only with there is a highly developed industrial system which is creates the regular demand and supply the short period instruments. So high demand in the industrial system which creates the uh, demand and supply short period instruments. So if this like this way we can develop our country can develop the money market. These are all the characteristics of the development of the money market. So these are all the market instruments. One is treasury bills, and the second one is call money market. Third one is certificate of deposit. Fourth one is commercial paper, and fifth one is commercial bills. So this five instruments we individually discuss. In money market instruments, first one is treasury bill. So treasury bill is nothing but why issue the treasury bill means this money market instruments issued by this money market instrument issued by the RBI to finance the short-term fund requirement of the government of India, discounted the face value. So this treasury bill is who is issued means RBI issue the this treasury bills for what purpose? For the purpose of the requirement of government of India, or for the government purpose only. For government, they have deficient funds. Then they can approach the RBI and they issue the treasury bills. Then like treasury bill, through the treasury bills they can collect the they can get the money from the RBI. So then for what way they are get the interest value for issuing of particular treasury bills. So the purchaser, that there is a discounted securities this issued at discount face value, the return to the investors. Okay, if I purchase the treasury bill, what is the benefit to me means if it is issued less, it is issued a discounted price value. For example, 1,000 rupees, if issue the face value of the particular treasury bill is 1,000 rupees, the but government is taking the money around 900 rupees only. So remaining 100 rupees is investors profit, investors interest. So likewise they are discount the bills, then they can get the money and they are giving the face value. The return of the investor is difference between the maturity value and issue price. For example, issue price is 1,000 rupees, uh, but that particular maturity face value is 1,000 rupees, but for issue price is 900 rupees and maturity value is 1,000 rupees. In between the maturity value and issue price, this difference between the two things the two values the profit to the particular investors. The major participants in the T-bill market major participants are the scheduled banks, financial institutions, mutual funds, educational and religious trustees. So these are all the major key players or major purchasers through when government is issue the money, issue the treasury bills. This particular persons they purchase that particular treasury bills, and they get the money back when the government is repay. Presently issue in present government of India or RBI, they are issuing three tenures they are issuing. One is 91 days bills, 182 days bills, and 364 days bills. The maximum value for the T bill is 25,000. There is no tax deducted source for this particular treasury bills. And treasury bills are T-bills which are money market instruments or short-term debt instruments issued by the government of India and are presently issued in three tenures. That is 91 days, 182 days, 365 days. Treasury bills are zero coupon securities and pay no interest, and instead of they are issuing at a discount and redeemed at the face value of maturity. Here they are not giving any interest to the particular purchasing person, particular investors, but they are issue the bills where discounted price, but they are pay the money to the investors face value. For example, 91 days treasury bill is 100 rupees face value, may be issued at the 98.20 paise. That is, the discounted of shares is 1.80 paise, and wood is redeemed at the face value of 100 rupees. Here they are issuing 100 rupees, but they are collecting 98.20 paise. Remaining 1.80 paise is this is the profit or this is the benefit to the purchaser of particular treasury bill. So this treasury bills issued by the government of this issued by the RBI. So just see. So 91 days, 182 days. This is the RBI web portal. 364 days treasury bills. Now 91 days bills is 8,000 crores. They are issued 91 days bills 8,000 crores, and 182 days bills 10,000 crores. 365 days bills is 9,000 crores. So likewise 27,000 crores in between January 31st to action. In January 31st they are actioning, and settlement date is 1st 2024. So through the treasury bills they are collect the money, and they settle the process in February 1st. The RBI actions the 91 days bills on weekly basis. So here just see the weekly basis. 182 days T bills and the 365 days T bills are fortnight basis on the behalf of the central government. The issued in the form of promissory note or by credit subsidiary general ledger. Through these two ways, they are issuing the RBI on the behalf of central government. This is the example of earlier they are issue the treasury bill like in physical form. They are issuing like this only. So government of India premium price bonds 1963 100 rupees bond. This is a 100 rupees bond. They are issued at some lesser price. These are all the futures of the call money market. This is a T-bill. And coming to the next instrument, that is call money market. Call money market is nothing but call money market is a integral part of the Indian money market, where the day-to-day surplus funds are traded. The money market is a market short-term financial assets that are close substitute to the for the money. The investors can be liquidate very quickly and very low cost. It provides the avenue for equilibrium of the short-term surplus of the funds of the lenders and funds requirement of the borrowers. These loans in the money markets are called the call call money loans, and money at call and short notice which carrying duration from the 1 day to 15 days. So earlier T-bills are issued at 91 days, 182 days, and 365 days. But coming to the call money, this these loans are issued to for the period of 1 to 14 days. The call money is money lent for the 1 day. Notice money is money lent for the period of exceeding 1 day but less than 15 days. Call money is 1 day, and noticed money is money that lent for 1 to 14 days, 1 to 15 days. These are all the futures to the main features to the call money market. One is call notice money is the money borrowed or lent on demand for a very short period. The money is borrowed or lent for the day. It is known as call or overnight money. And in interweaving to the holidays, Sundays are excluded for the purpose of this particular call money market. Thus, the money is borrowed on a day and repaid to the next day, irrespective of the number of interweaving holidays. This is called as call money. When money is borrowed lent for more than a day and up to the 14 days, this is called as notice money. No collateral security is required for the covering of this transaction. Term money refers to the borrowing lending of the funds for the period of 14 days only. Okay, here call money is a day money. Within 1 day they pay overnight, they can pay the money. And notice money means 1 to 14 days. 1 to 14 days they are lent and they collect the within 14 days only. Term money means the borrowing and lending of the funds for the period of exceeding of the 14 days. This is called as term money. So call loans are generally made on clean basis. There is no collateral securities required, and the main function of the call money market is to redistribute the pool of day-to-day surplus funds of the banks among the other banks in a temporary or deficit of funds. So some every bank they maintain some deficit. They maintain the uh, some money. So if some banks have more money or surplus funds, they send that surplus amount to the deficit banks. So likewise, they are equilibrium the equilibrium the funds in all the all the organizations. The call money helps the banks economize their cash and it improve their liquidity. This call market helps the banks to economize their cash and to improve the liquidity. It is a high competitive and sensitive market. It is a very high competitive and sensitive market. It acts as a good indicator to the liquidity position. Fixed income money market derivatives association of India. So this FIMMDA, they given some formula. They are given some formula to calculate this call money market interest rate. Okay, this is the fixed income money market and derivatives association of it. This association, they are fixed the interest rate to the particular call money market. Interest rates are subject to seasonal and volatility basis. Coming to the third instrument, that is certificate of deposit. Certificate of deposit is nothing but it is unsecured institutional and demonetization or bearer form of issued by commercial banks and development of financial institutions. Certificate of deposits were first introduced in June 1989 following the recommendations of Waghwal Working Committee. So the recommendations of this particular group of company this certificate of deposit is issued. It is an unsecured negotiable instrument issued by the commercial banks and financial institutions. So the CDs are short-term borrowing in the form of UPN. UPN means usageless promissory notes issued by the all scheduled banks and are freely transferable by endorsement on delivery. This is introduced in the 1989 Wagdul Working Group based on the recommendations of Wagdul Working Committee. Maturity period is not less than 7 days and maximum up to the 1 year. 7 days కంటే ఎక్కువ ఉండాలి, 1 year కంటే తక్కువ ఉండాలి అనమాట. దిస్ ఫర్ ఇష్యూయింగ్ ఆఫ్ పర్టికులర్ సర్టిఫికేట్ ఆఫ్ deposits. And some certificate of deposits also more than 1 year up to the 3 years. The subject to the payment of stamp duty under the Indian Stamps Act 1899. Issuing to the individual who to issue it is issued to the individuals, corporations, trustees, and fund and associations. There are the issue rate discounted freely determined by the market investors. Fourth instrument is commercial paper. Commercial paper is nothing but it is an unsecured money market instrument issued in the form of a promissory note. Commercial paper was introduced in India 1990 with the view that enabled highly rated corporate borrowers to diversify their sources of short-term borrowings and to provide an additional instruments to investors. Subsequently, promissory dealers and all India financial institutions were also permitted to issue this particular commercial papers to enable them to meet the short-term funding and requirements. So these are all the features to the commercial paper. That is, companies primary dealers of financial institutions. Then after individuals, banks, other corporate bodies and uncorporate bodies, non-resident Indians, foreign institutional investors are eligible to invest in a particular commercial paper. Commercial paper shall be issued for maturities between the minimum of 7 days to maximum of 1 year. Commercial paper shall be issued to a denomination of 5 lakhs and multiplication thereof. So commercial paper shall be issued at a discount on face value may be determined by the issuer. The company should eligible for the commercial paper for they are tangible for net worth of 4 crores. So for net worth of particular they can eligible for the issue of commercial paper. Their net worth is more than the 4 crores. The commercial paper is issued for the purpose of promissory note and can be the physical form of dematerialized form. No issuer can underwrite their issue of commercial paper. Every issuer must appoint the issuing and paying agent for a issuing of commercial paper. Eligible issuers shall obtain the credit rating issuance through commercial paper from any one of the SEBI registered credit rating agencies, and minimum credit rating is A3. If required, and issuers may buy back the commercial paper issuing before the maturity period, and commercial papers are actively traded in the secondary market. This commercial paper is also traded in the market. Commercial bill. Commercial bill is the seller who draws the bill has the option to discount the bill and get the immediate cash instead of waiting until due date for the bill. So this commercial bill is seller who draw the bill as option to discount and will get the immediate cash instead of waiting some period. Okay, these are all the features relating to the commercial bills. That is, the term of the commercial bill is 30 days to 30 days, 60 days, or 90 days. It is important to finance in a credit sale. This important in credit sale. Um, this commercial bill is most important. Inland bills are drawn and payable in India. Here, three types of bills are there. One is inland bill, another one is foreign bill. Third one is hundis. Inland bills are drawn and payable in India. Drawn in India and payable in India only. That we call as inland bill. Foreign bills are drawn outside India but payable in India. Foreign bills are nothing but it is drawn outside but payable in the India. That type of bills we call as foreign bills. Hundis are drawn on the sale of agriculture products. So hundis are nothing but these bills are drawn on the sale of agriculture product, discounted and financial finances of India. This is the This is the bill market. Bill market RBI is set up for the this particular commercial bill purpose. RBI set up is the set up one organization that is Discounted and Finance House of India. One minute. These are all the futures relating to the commercial bill. Tools of the liquidity of management, that is the important objective of liquidity management include price stability and ensuring the adequate flow of funds to the productive sectors of the economy to support the economic growth and ensure the financial stability through controlling and expansion of the bank credit and deregulating the interest rates. These are liquid This is here methods of credit controlling uh, through two ways. In India, they are controlling the credit or liquidity. These are all the two ways. One is quantitative or general method. The second one is qualitative or selective method. So in general method, one is in general or quantitative method. First one is open market operations. In open market operations, the buying and selling of government securities and treasury bills, RBI in the money market is called open market operations. Here, the buying and selling of government securities and treasury bills by RBI in the money market is called as the open market. So here, in case of inflationary situations, the RBI is sell the securities in the deflationary situations. RBI issue the securities to the general public. Likewise, they control the price in flow of the money. They control the through open market operations. Uh, Second one is bank rate. It is the rate at which commercial banks can borrow the funds from the RBI. bank rate is nothing but commercial banks, they can borrow the RBI when the inflationary and too much money supply system, RBI will increase the bank rate so that the banks are discouraged from the borrowing from the RBI. So in inflationary situations, RBI increase the rate, increase the bank rate. Then commercial banks cannot, they cannot. Okay, ma, I will tell the important questions in last class. Okay, that is 10th February, 11th February. So that time I will tell you, no problem. Okay. Even anyway, we have two important concept. Speedily we concluded within 5 minutes. Just wait. Just stay for more than 5 minutes. Then we conclude this chapter now. Um, bank rate is nothing but it is a bank rate is a commercial. It is a rate when commercial banks they are borrowing the funds from the RBI. When inflationary situations, RBI increase the bank rate, and in deflationary situations, RBI decrease the uh, bank rate. CRR. CRR is nothing but it is refers to the cash that banks have maintained with the RBI and the percentage of the total demand and time liabilities. So based on the demand and time liabilities, the back all the banks some cash maintain in the RBI. In inflationary situations, it is increase the ratio. CRR ratio will be increased. In deflationary situations, that particular CRR ratio or deposit ratio will be decreased by the RBI. Likewise, they control the liquidity position in any country in India. Statutory liquidity ratio, it refers to the investments in the cash, gold, unencumbered securities that banks have to maintain as a percentage of their total demand and time liabilities. In inflationary situations, increasing the ratio will reduce the money supply and the system of the vice versa. Statutory liquidity ratio means nothing but it is some any bank they invest some money in cash, gold, and unencumbered securities. So this is depending upon the inflation and deflationary situations. This SLR also RBI increase or decrease based on the inflationary or deflationary conditions. Repo and reverse repo rate. Repo means under the liquidity adjustment facility, RBI offers the repo and reverse repo facility to the bank. The simple words, repo is right with the banks can get the credit from the RBI. Okay, repo rate is nothing but banks can get the credit from the RBI. The reverse repo rate is banks can get their deposits with they keep their deposits with the RBI. It can inflationary situation it reduce the money supply and economy of the repo rate and reverse repo rates also increase. Okay, in inflationary situations repo rate and reverse repo rate also increased. These are all the quantitative methods. Second one is qualitative methods. Qualitative methods is nothing but the qualitative methods are used for specific cases on selective way. They include rationing of the credit, adjustment margin loans, varying rates of interest and loans, publicity, moral situations, and restoring direct actions. Okay, this is the main difference between the qualitative general method and selective methods. So these are all the defects to the Indian money market. One is autonomy between the organized and there is a difference between the organized and unorganized sector, and predominance of the unorganized sector, withdrawal of the competition, absence of all India money market, inadequate banking facility, shortage of capital, seasonal shortage of funds, diversity of interest rates, options of the bill market. These are all the defects of the Indian money market. Okay. Up to this, I concluded my session. This in the next class we start the foreign capital. Anybody have any doubts?
No, sir.
Okay, ma. Okay, ma. Thank you, ma.